Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's June 21st, 2019, episode 33. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we are joined by Tavi Costa from Ceresna Capital, where he lays out his bear case for equities. And then we have a special TV segment with Market Huddle chugging champ, Tony Greer. I have a tale from the trading desk of my days on the trading desk and watching an epic battle between Robertson and Soros.
And in this week's trading history, I'm going to talk about the origins of candlestick charting as well. We're going to get into the top 5 things to watch this week.
Okay, let's jump into it, Patrick. I've been dying for my beer. I've been sitting here waiting to open it. Lena, hop on and let's get on to our beer. What do we got this week?
So we're drinking anti-gravity lager.
Right, 1 second. I'm just going to say this one is especially apropos because that's what I feel like the bonds are experiencing right now.
All right.
Anti-gravity.
Anti-gravity lager from Flying Monkeys Craft Brewery.
Yeah.
So it says, light by any standards, but still up to Flying Monkeys standards, anti-gravity accomplishes our mission to craft brew a light beer that actually has flavor. Our vision was to challenge the watery stuff that makes us craft beer snobs confuse our distaste for big corporate beers with distaste for all light beer. Onward and outward, Flying Monkeys.
Nice. This is definitely sessionable.
Yeah,
Definitely
4%.
and crushable.
Yeah, crushable. I like that, Lena.
Crushable. I already drank one.
Lena went ahead of without us.
I couldn't wait. I'm a big
Oh my
fan
God,
of
that is
water.
so ordinary. I mean, like this is
Patrick,
a beer.
I've told you numerous times you don't insult the sponsors so early.
No, but I mean, okay, all right. Listen,
It's a little
listen.
too average for you, Patrick. I think.
No, I know, but
Considering you
listen.
like
After
He
the
likes the goddamn
sponsors that we've
sours.
had, that have given us like this whole spectrum of taste. Like this is I could grab a 2-4 of this and
is
pound this
classic.
back at the cottage, right?
Yeah.
Like this is it's.
I like
as
it.
about-
I like it. I know it's light beer, so I shouldn't be liking it, but I like it. I got to watch my girlish figure, so it's good for me.
Yeah, I gotta shed my winter coat.
All right, Kev.
Okay, let me do our...
Give us the legal stuff.
Yeah, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include, and we only have one side effect this week, Patrick, recreational alcoholism.
I think we're all suffering. That.
That's right. Recreational
All right,
alcoholism. I like the way that was put. It kind of
okay.
makes it a little bit like I don't know, glamorous or something. I know it shouldn't be. It's not a laughing matter, but I liked it.
But on this show,
I guess it
We-
is a
we
laughing
laugh.
matter. Yeah.
yeah. All right, let's move on to our guest. So joining us now is Tavi Costa from Ceresna Capital. How's it going, Tavi?
Good. How are you guys doing?
Oh, we're doing pretty good. We're doing pretty good. So we brought you on because you've been all over Twitter and on the internet with some great narratives, and we wanted to hear your story. So you generally have a narrative that is somewhat bearish the stock market. And well, why don't you take us through what you're thinking and where you're what you're doing in the markets right now?
Sure thing. So initially we found we started accumulating a few of our, what we call just macro warning signs that from our research it started to add it up. And the first one that began to give us conviction about this idea was our macro model. We built a Ceresna's macro model. It's like a 16-factor macro model that includes unemployment rates and credit spreads, consumer confidence, valuation factors, a few technical indicators. It's actually a very simple model, and it's just adding up factors. We know that no single factor would work throughout history very well, but if you can accumulate many of them, that can give you an edge of at least know where we are in the business cycle here. And that whole model was scoring, if it scores close to 100, and 100 would be the most overvalue and late cycle stage of the markets. And we're now 2 percentage points away from that. The model goes back to 1987 or so. And that's obviously just one part of it that kind of gave us the conviction to take the more defensive stance. But overall, we just think that, if you start looking at just the stocks in general, look absurdly overvalued in so many ways. I mean, one way we put out this table, I think it's in the second slide there, looking at 8 different ways of stock market valuations, and about 5 of them are actually pretty much at all-time highs, and 3 others are pretty close to it as well. So it goes all over from median price to book to even just the record leverage of corporate in general, and not just public but private markets as well. So we started accumulating those with the actions of central banks as well. If you go to the fourth or third slide, looking at what we call the global yield curve inversion, that was really a moment of realization for us of this is not just in the U.S. This is a bigger problem, and we started looking at obviously I think that's not new for anybody. The global debt to GDP ratio has been at unprecedented levels, but when you look at things like 30-year yields of nominal rates for countries in general, about 16 economies today have their 30-year yields lower than LIBOR rates, overnight LIBOR rates, and it's stunning because that if you put that throughout history, this inversion tends to happen right when you're at the peak of a bubble. So
Now,
this
Tavi,
is
can I ask you a question? So when we're talking about the global marketplace like this, obviously we always put a spin on to looking at U.S. equity, but really one of my narratives all along has been the fact that the entire world has been falling into an economic slowdown and potentially an economic recession. And the U.S. has sort of been kind of marching to the beat of its own drum while the rest of the world is slowing at this pace. I mean, do you believe that the global economic recession is going to sort of drive the weakness in the U.S.?
Absolutely, yes. I think that Jeff Gundlach this week put out in a good way, calling the U.S. being an anomaly versus places like the rest of the world. If you looked at MSCI index excluding the U.S., I think it's off like 12 percentage points from its peak. Other things like internals, like the small caps here in the U.S., are down close to 10% from its peak still. So showing a very different move from the S&P 500 now at all-time highs. So yeah, I think that the global the slowdown, in our opinion, if you look back since the global financial crisis, over 50% of the global GDP growth have come from China. And we have a very bearish view on the Chinese economy it's actually a very kind of a long story, but it's a shrinkage of the current account and becoming less of an export-led economy, even though it's not shifting towards a consumption-led economy either, as you can see. But it's so all that put together, tell us that U.S. stocks being the record valuations just makes no sense. And the third part would be just looking at precious metals at the same time as a sort of a safe haven asset. Being a historically cheap levels just also looks very attractive. So it's there's a lot of interesting things happening out there, but obviously the U.S. being an anomaly is what calls our attention here to be have a very bearish stance. You can see that in so many ways. Like more recently, I think somebody put out a research looking at VIX, for instance. I think the 10-day correlation with VIX and the S&P 500 has just turned positive, and reminds me of the late 2017, early 2018, right before that large sell-off and volatility spike in early 2018 that lasts all the way to February. It's actually very similar to that, but there's the liquidity or the volume itself on SPY, the ETF of the S&P 500, and the E-mini too, the futures, has been really, really poor. I mean, it's usually that tends to lead to sell-offs in the market. At least in the last two sell-offs were caused by this kind of calmness in markets in general that kind of led to a big crash. But the imbalances are you can see the imbalances of record valuations in so many ways.
All right. So when we're looking at this chart over here, when you're talking about the percentage of inversions in the U.S. yield curve, what are you trying to show us here?
So the beginning of that was, I always thought was interesting to look at 2-year yields versus 10-year yields, and obviously haven't inverted yet. And I was looking at, sort of confirming the thesis after looking at the model that we created. I was looking more for confirmation of the thesis, and obviously that was a big part that wasn't really telling me why. Some can say, well, it's because interest rates are too low, and that kind of drove me to, well, what's happening with other spreads? And that's how kind of I created this, looking at, several spreads. And I was like, well, what's the percentage of those spreads that are actually inverted today? And then what that looks like throughout history, and it's, so I accumulated all these possible spreads of the yield curve. So it's 44 spread calculations, and all the way from 30-year yields, 10-year yields, all the way to overnight rates. And when you look at that, it's somewhere close to 60% of the yield curve is now inverted, which is just as high as it was at the peak of the housing and the tech bubble. But now, if you compare that, we hear a lot of we're going to have a sort of a soft landing scenario like we had in 2016 with the Fed kind of pausing its rate hike cycle and turning, extremely dovish back in those days after the first hike in December of 2015. And that, kind of led to the extending the business cycle here where we are today. But that's not, this chart shows you very clearly that that's not what the credit markets are telling you. Credit markets are telling a very different story. At that time, the percentage of inversions was actually really low. This time we're seeing, it's not an unprecedented amount, but it's just as high as other, very severe bear markets that we had in the past. And the one thing that I like about this is, yeah, sure, inversions are important because they tend to be kind of a bellwether for stocks, as credit markets tend to be a bellwether for stocks in general. But the other part of it too is how precious metals tend to do really well when inversions happen. I think that you can look at it in so many ways. If you look at just inversions, let's say of 3-month yields versus 5-year yields or so forth, especially in the front end of the curve of those small inversions, they all, every time it inverts, first it tells you that you're late in the cycle, but also it tells you that you're at the beginning of a big move. Or for precious metals, one way we can look at that is gold to S&P 500 ratio tends to do really well in inverted times of the yield curve. So that's kind of how. Sorry for the long story here, but that's kind of how it developed this whole thesis.
Okay.
Yeah, no, it's good. So, Patrick, actually, I wanted to ask something. It's Keva here. So, Tavi, I see you guys talking about the twin deficits, and it's been a long time since anyone's kind of brought that to everyone's attention. I was wondering where you're going with this, and why this is like a blast from the past in terms of a warning sign that you're kind of highlighting everyone.
That's a good question. So the twin deficits, it's obviously a lot of these charts that I create, or some of these charts that I create are not necessarily just my ideas. I'm just expressing them through charts that look kind of interesting. But one thing that we hear a lot is that twin deficits would be very negative for the dollar and so forth. And I don't necessarily disagree with that, but I just think that there's a much higher correlation between the deficits and the S&P 500. You can see very clearly in this chart. So and right now we have this massive alligator mouth with government debt increasing at the same time as the current account balance is also significantly lower, and So those two things put together, you would expect that the S&P 500 would follow on the downside and catch up there with the twin deficits now at what, -7 or almost 8% relative to GDP. So I think that's the big difference. I think a lot of people tend to look at this and kind of relate back to the dollar, where I think that the equity markets being at all-time highs with historic valuations and inverted yield curve and so forth. I think that all adds up very well to create more of a bearish a thesis for stocks.
Right. Okay, so we know that stocks are expensive. What's cheap?
Well, what's cheap is we think it's precious metals in general. And you can see that in so many ways. When you look at the commodities to the S&P 500 ratio is a big one. This chart is even this one in this case is going back to 1970s, but there's another version of this chart goes back to 1900s. And today in this ratio, first we're well below the median. The historical median of this ratio in general. And also the other part of it that is important is that we're also at even below times that preceded the Great Depression in 1929. So it goes to show that commodities have been depressed. Prices have been suppressed for a long time, and among the commodities, what we like is obviously precious metals. We have a little bit of the soft, so agricultural commodities is another thing, another long position that we have in the portfolio. But it's not a theme. It's not as big as we have a view on gold in general, as I just mentioned. If you have the problem in credit markets right now and how gold is likely to behave as a true safe haven here if we do have a recession, as we think we will, I think that this ratio is going to move towards the other way. And obviously this ratio has a lot of weight on energy, and it's one of the reasons for being at the level where it is today. But for us, on the commodity side, it's hard to have a long view on energy, even though, I completely see the side of the geopolitical issues kind of heating up recently, especially in Iran and so forth. And, that could drive oil prices higher. But, when you have a very bearish view on the Chinese currency and China being, the largest buyer of oil out there, I mean, it's hard to make a case for oil in my view. So I think that I prefer being more agnostic on oil and being very long gold and precious metals in general. Silver, you look at, things like, I don't have this chart here, but anybody can do this. Just look at Russell 3000. It's like just a broad stocks, a broad way of looking at the equity markets in the U.S. relative to silver. Look at that chart. I mean, it's, that ratio just kind of double topped. I mean, it double topped and kind of retested the 2000, insane valuation levels we had in equity markets. And it's also been caused by silver. Silver has been, it's been in a bear market for 7 years or so. I think since April of 2011, I think it's April of 2011, silver prices are down over 70%. I mean, it's just, stunning when you have all this bearish views and you see kind of the high beta version of a safe haven asset like gold, doing so poorly. So that's where I
So Tavi,
go ahead.
I completely agree with you, Tavi. I think that silver, they're giving it away. Now, one of the things that you mentioned is that you were talking about the oil and the fact that it rallied recently, and that it was basically on geopolitical concerns. Yet before that, oil was basically shitting the bed. It was having some trouble. It was having it was declining, and yet during that same time, gold was rallying like nobody's business. And I think you've got an interesting chart that this has happened in the past, and this is a good signal. Why don't you tell us about that?
That's a good point. So the gold to oil ratio that you're referring to is very telling. It tends to mark some critical junctures in the market in general. And, you had that in global financial crisis, the European debt crisis, and that first oil collapse and that, first glimpse of the China credit bust. And then, I'm referring to when this ratio starts to really, rise significantly or surge in some points, or break out from a multi-year line or so. That's when you should be aware of it. And it's, the other part of it too is, right at the beginning of one of the worst sell-offs and quarterly sell-offs in the history of equity markets, which was the fourth quarter of 2018. Guess what was happening at that time was the gold to oil ratio that was surging right before that, and kind of coincided with that whole sell-off. And that was actually, if you looked at when it started to surge, it was also right before the G20 meeting in Argentina in Buenos Aires. So it's a right now we're seeing kind of the same idea, right? We're all expecting here the G20 meeting in Japan, and this ratio is surging. And first was kind of caused, like you mentioned, by oil, but now we're seeing gold breaking out. This move on gold is real, and it's just it makes a lot of sense for us to be long gold right now, and this is just kind of another macro signal for us that it's proving to be just another bearish sign for the markets in general. But
well, you know what? I'm gonna cut in here
so-
because I wanted to get you into this chart over here, because you were talking real yields versus gold, and I thought that the correlation on this chart is fascinating. Why don't you give us a quick rundown of what we're looking at?
yeah, so the initial part of this chart, actually, I'll go back, go to the chart before, because I think it gives a nice introduction of that chart, which is looking at 2-year yields. The first part of that chart really is that, I mean, anybody can look at this chart in a very simple way. It's one of my favorite charts, really, because you can, you just get 2-year yields and look all the way back to the 70s, and you log that chart and you connect the tops of it. And then every time the 2-year yields touch that line of the multi-decade resistance line, and starts to fall, that's really when you were at the peak of a bubble. You had that in the double dip recession and the tech bust and the global financial crisis, and now you're seeing that today again. And so essentially what's really causing is that obviously nominal rates are dropping because the credit markets are pricing in that the Fed is going to start easing significantly, and that obviously has an effect on real yields. So the next chart on the real yields, as you start to see that, that's really what's driving real yields to move the way it's moving. So in here we were looking at 5-year yields, real yields inverted. When you looked at that, it's actually the inverted version is breaking out now from a 6-year resistance line here. So it's pretty interesting that how that follows gold very closely. So if you're expecting nominal rates to drop even further, you would expect real yields to do the same. So the inverted version should go much higher, and gold prices should follow the same line. So it just gives us another way of looking at gold and how it's likely to perform well if especially if we're likely to see nominal rates continue to drop as we think it will. But
Yeah. So, Tavi, I've long believed that 5 years tips yield is one of the most important drivers of gold. So that's a chart that's near and dear to my heart. So we have from you short equities, long precious metals. The third part of your 3-pillar kind of theme is that China is one of the largest credit bubbles that we've ever seen. And I want to go to chart page 20 here, because you have a chart there that's long gold in CNY terms versus short global stocks. And I think that's a fantastic chart. Why don't you tell us what you're thinking there and where the opportunities
So
lie?
we call this the macro trade of the century. And at the beginning, there's a lot of moving parts in this chart, obviously. So you guys know the global or short global stocks version was kind of covered already. The second part of it is long gold, that was kind of covered too. Now what we realize is, first, China is perhaps the largest credit bubble we've seen in history, and we can dive into that. But in the simple terms is that every time you have, or most times you have a credit bust in especially emerging markets, what you see is actually gold rising in local currency terms. And a lot of people have been saying that gold hasn't really moved. Actually, right now it's kind of a popular thing to say that gold is moving, but a few months ago it wasn't. And it's actually not true. Gold hasn't really worked as a safe haven here in the U.S. But if you're in Brazil, if you're in Argentina, if you're in Turkey, gold has worked really well, and it has protected yourself very well if you want to get some sort of protection from your currency devaluation. So we expect all this credit buildup in China to lead to a value destruction of their currency, and therefore we expect the Chinese yuan to really devalue against the dollar. And as you can see that, I think I think the gold prices in renminbi terms is likely to rise. If you looked at just the gold in renminbi terms throughout history, it's actually for the last 3 years or so, it has been kind of pegged, and more recently has been kind of breaking out from this, kind of a flat line. And so, we think that, we're likely to see a much bigger move in gold prices in renminbi terms. And the other way you can see that, because, as I said, we like gold being long gold versus U.S. stocks. And, thinking about that because of the inversion of credit markets in general. And then, I wanted to take that to another level. And I was like, well, we're very bearish on China. How can I express that in a chart that will really, be able to kind of show, it's almost like 80% of our positions in our global macro fund is in this chart right here, which, every time long gold and CNY terms and selling U.S. Global stocks, rises, when this ratio starts to rise, you've seen kind of turmoil globally or turmoil in China specifically. So, one of them being, if you looked at in 1993, China had a devaluation of their currency of it lost 1/3 of its value in literally one day, right at the last day of 1993. And it's kind of what we're calling for, not necessarily the time frame of one day, but we think that the Chinese currency will devalue significantly in the following months, and that's one way to do it is being long gold in renminbi terms and being short global stocks in general, which kind of involves being short mostly U.S. stocks today because they're really at the peak, but there's also Canadian banks and Australian banks and so forth, which is all related to the China thesis.
Well, that's some terrific stuff. Thank you so much, Tavi. So we're going to wrap it up here. But for those who want to learn more about Crescat Capital and all the different research and the products you offer, where can they find you?
So first you can find us in our website. Crescat.net is one way to do it. But I'm actually very active on Twitter. I try to post things pretty much every day. I try to be as independent as possible and put out good charts and good content that tells a story and of the narrative that we believe. Kevin Smith as well is pretty active. I don't have here his handle on Twitter, but Kevin Smith from Crescat Capital, if you type that on Twitter, I'm sure you'll find it. But I think those are the best ways to do it. I'm also trying to create a few videos on YouTube just to get another exposure in a different social media website, just to see how that works. And again, I just want to spread the word around from things that I believe in. And I think that we have very good research. Then why not share with other people as well? So that's kind of the I think it's very easy to find us around there, around the internet.
Terrific. Well, thanks a lot, Tavi. And for those who want to follow Tavi, he can be at TaviCosta. Well, thanks a lot. It's been a pleasure having you on, Tavi. And for those who want to hear more, make sure you stick around for the after hours where we're going to get into some of the more exciting and kind of esoteric parts of Tavi's positions.
Now, Kev, we had a phenomenal opportunity to meet up with Tony downtown Toronto. Why don't you give our listeners a quick rundown of what they're about to see?
Well, Tony was lucky enough to be in town while we were taping something else special to be determined later, to be kind of announced later. And he joined us, and it's unfortunate because we did it right in front of the Fed announcement. And I wish that we were able to play his tape before the Fed announcement, because, man, did he nail one of the calls. He came out and he said something and he got it so right. And, Tony's always a great guy to go drinking with. And not only that, he's proving himself to be quite the market timer with calls like this. So it's unfortunate it's a little bit late. Just remember, he did this on Wednesday at 1 o'clock, well before any of these big moves that happened subsequent. So let's watch it.
Well, a special treat for all you market huddlers out there. Usually you only hear our voice. This time you get to see us. And not only do you get to see Patrick and I, you get to see Tony Greer. Thanks for joining us, Tony.
Thanks for having me, Kev.
Well, we're actually taping this right in front of the FOMC, so we don't get to know in advance what's going on. What's on your mind in terms of what you want to talk about in terms of the market?
I think Mario Draghi is trying to make gold great again, right? with his next level, dovish call.
Right.
It's kind of an extension of whatever it takes. He's prepared to cut rates even lower. The European bond market is absolutely soaring.
Yeah.
The pool of negative yielding securities is once again soaring, and it makes gold look interesting again.
For sure.
We're at a huge technical level, and it's something that you want to sort of be full size if we break through that level for the best bang for your buck, and that's where I'm trying to get to right now.
Do you think it's going to break out?
I do think this time.
Yeah.
I like him.
Yeah.
That's the type of gold.
It feels good. It feels good, and I will give up on it in any split second. Though you have to know, I'm a long-standing gold trader, right? And when I see the failure, I know what failure looks like, and I will bail out at that point. I hope, but I'm also usually the one trying to push it through.
Now, do you think we're going north of 1,400 in this push? Because I see a lot of technical measure moves that I do that are suggesting that gold is going to make that push like 1,380 to 1,400, but I don't know whether it's going to make that big breakout, which is the start of a real bull market. Like, what's your feeling?
Well, I think that we have to see what's above 1,375, right? And I think that the stage is set for us to actually go find out what's up there. I think 1,375, 1,400 happens in the same move. Right, so I think that move kind of takes us up into 1,400 because I think there'll be a lot of people stopping out. I think there'll be people adding to longs. And what's interesting is that gold has been in a really sort of flat consolidation pattern since probably 2015 now, right?
Yeah.
For say call it between 1150 and 1350. So we've got a real chance to break out now. It feels like the type of market environment where things are going to change. You know what I mean? It feels like I'm nervous about the Fed today. I'm nervous about what Powell's going to come out with all the pressure that Trump's had on him. Now Trump sees Mario Draghi go full dove, and God knows what could happen now.
You know what's interesting about Mario Draghi? I was just reading in the paper the other day in the Financial Times that he actually said that they discussed this new stimulus, but it wasn't the case. There was nothing. He's pushing the rest of the committee members into that policy position on his own.
Yeah.
So it's like these central bankers have gone crazy, and when you combine it with the fact that Trump, the pressure that he's, we were talking about it a little bit earlier. This is unprecedented in terms of what Trump is doing.
The story this week was mind-boggling.
Yeah,
that he's looking to see if he could unseat the Federal Reserve chairman.
Yeah.
I mean that's I don't even know what to say about it.
He's bullying.
Yeah.
He's bullying Powell into becoming more dovish than he
and it's a new paradigm. But what's unbelievable that you really have a tough time making a case for strict, steep rate cuts in the U.S. right now.
Oh,
right.
I know.
mean, you have a really tough time making that case.
Unemployment's low. Inflation, although it's not plummeting, it's still relatively high.
Our PMIs are still above 50, showing expansion. The stock market's, a couple percent from the all-time highs, and we've got a president that is literally pounding the table on a rate cut just because he wants to watch the stock market go up.
Well, the other thing that I find interesting is the fact that the Wall Street has managed to bully the market and Powell into pricing in 3 cuts. And I think that that's a really, really interesting spot for Powell to be faced with, because if he doesn't deliver those 3 cuts, the market's going to sell off, and what is that going to mean? And then it's going to be Trump on him all the more. So it's almost like Wall Street is teamed up with Trump and figured out that they can push him around.
Yeah. And you want to say, at some point you want to shake some sense into the president and say, so if the economy keeps roaring along, what do you think rate cuts are going to do, right? I mean, it should cause some kind of a crazy inflation streak, which we haven't been able to cause. So I can understand their point there, but it just doesn't make sense. It doesn't make sense.
What's your over/under that we break to new highs on the S&P?
I still think that the S&P is struggling to sideways. The S&P has been kind of dead money for a year and a half now, right?
Yeah.
I mean, and it's been not only dead money, it has been hysterical, crazy, vomiting type of money, right? I mean, if you're in the S&P for the last 2 years, you've basically had a 5,000 point round trip, right? That's not a comfortable place for your money. And neither is negative yielding securities. And so that's why I feel like I've got this angle on gold now where it should go.
Right.
It should go. If we just look at it sensibly now, it looks like everything has changed enough and the technical pattern is right before our eyes that gold should go. I think crude oil is also exciting to keep an eye on now, especially with the tanker story. Mike Pompeo saying that Iran attacked the tanker.
Right.
Japan saying we saw flying objects before the tanker was attacked, sort of refuting the story. And we've got this crazy black and white video of, God knows where it came from or something like that we're supposed to believe is the Iran trying to take out a Japanese tanker, and I just can't buy into it.
So what do you think's happening there?
Well, the oil market isn't really concerned that the Strait of Hormuz is going to get shut down anytime soon. So I feel like it's the oil market is sort of thumbing its nose at the event, right? The event. They're looking at that event in the Gulf and saying, this isn't the one that closes the strait.
Right.
This may be the one that you're trying to cause some international saber rattling about or something like that. But we don't look at it as the one that closes the Strait of Hormuz, which is the only thing that's going to put a $5 to $10 spike on the oil market right now.
So I was at a macro lunch the other day, and we were talking about the Iran kind of situation and how it was and what Trump might do. And although there was kind of consensus that there would be no way that he would start a war with Iran, the possibility of him kind of lobbing in some missiles is probably higher than the market realizes. And then there was a really interesting fellow at the lunch that mentioned the fact that if you're Iran at that point, you don't respond against America. What you do is you go and you lob your own missiles at Gawar. And he was telling me he was shocked at, it was news to me about how much of the world's population or the world's production of oil comes out of that one field. We all know that it's the biggest field in the world, but in terms of the production and the capability, you could take out that one point of contact with a very easy bomb. Yeah. And it made me go out of this lunch and think to myself, everyone's out buying S&P puts to protect their portfolio in case something goes wrong. I almost would rather own crude oil calls. Yeah. Yeah. Because I think there's a chance that we could have $100, $200 oil if something really heats up.
Wow. That's a big number, but I mean...
Are you bullish on oil?
I'm kind of neutral right now, to be totally honest with you, Patrick. I was bullish for the move to 66, and then it literally reached one of my technical targets, and I let out all of my length, and I said, I really want to be flat oil here, but long oil volatility. That's a call that I made on Real Vision. And oil volatility luckily spiked a week or two later.
Great call.
Big time. Yeah, it was big. It was a good call. I managed to be long a put and a call, so I made a little bit of money. But in broadly speaking, Patrick, no, I still think it's kind of 40-60 range bound. I really do. I think the Saudis are going to do everything they can to spark another production cut and try to get it going on the upside again. But the problem is they've got spreads have collapsed now, right? So since spreads collapse, it's not as appealing for hedge funds to get in with negative carry in the oil market, right? They like to get in when there's a steep backwardation and they can earn $1 on the rollover or something like that. So I think that may have washed a lot of length out. And so I feel like the market might be kind of balanced right here, right now, given we don't blow up the Strait of Hormuz. Right. You know what I mean? That's the wild part.
That might be an interesting way of trading, because I personally was looking at shorting oil when it gets up into the high 50s. Once we get in, that's the upper.
Insane.
But with your idea though, at the same time, owning some out of the money call options as a hedge against that. That it gives you that insurance that if something does happen, you've got that tail risk priced in. I think that's an interesting way of playing it.
Okay, so go ahead.
No. I was just going to say I like your oil upside call potentially because the vol will work with you if it goes up.
Right.
You know what I mean? So I think that you might get an even bigger vol bang on the upside if oil spikes than you will in the VIX if the S&P goes down.
Right, you're absolutely right.
So that's what I think that you might be able to make a big play there. That's why I like that call.
Okay, so we're getting tight for time. We're going to ask for your last opinion. Everyone's talking about bonds. What do you think about the bond market?
Oh, man. I mean, I've got 2% as my line in the sand. And, I literally just recently tried to fade this move right now with an IEF short. That's the 7 to 10 year Treasury ITF. I'm still shorted, but I've got to stop at new highs. And I know right now that the market is going to prove me right or wrong, right? We're either going to know that the US 10-year is going to bounce off of 2% 3 or 4 or 5 times, but it's not going to break it, and maybe bonds sell off and yields rise. But, with Draghi out, and I'm nervous about the position today, obviously Powell could say something super dovish that kind of sends things.
Well, what kind of doesn't portend well for your position is the fact that Patrick and I have a bet, and 2% is also our line in the sand.
Oh, no.
And if it clicks that, I owe him, I lose the bet. So more than likely, that's what's going to happen.
Yeah, that's what it feels like. I feel like I'm going to get plucked on my Treasury short.
Okay, well, it's great having you with Tony. Thank you. Thank you very much for coming. It was a pleasure having you
here. It's great to be here in Canada.
All right, cheers.
Cheers.
It is kind of weird, this beer.
Don't erase that. That's important to keep in there, Lena. Okay. No, just kidding. So here we go.
No, you can leave it in. Let's go. Lena, leave this in, and we'll just go right into the let's go.
Here we go. So it was great to have oh my God, edit this shit out. Forget it. Here we go.
Leave in, Patrick. Just leave
Kev.
it, Lena.
All right, take it
leave
from the top. Take it from the
Lena.
top.
No, leave all this shit in. It's hilarious. People like it. Leave it. I'm telling you,
Lena
leave
put
it.
it
I'll be
behind
upset. Not that I listen to it, but like I'll be upset if this isn't in here. Okay,
All
let's go.
So, tales from the trading desk, Kev.
Okay, it's my turn, right? So I have to
Yeah.
talk about something here. Okay. You know what? I'm going to take you back to 1990. I guess it was 94, 93. I was a young pup sitting on the institutional trading desk, and I was just earning my stripes. And I had a boss that was just, he was 5 years older than me, and he was sitting there beside the head trader. And we were on the institutional equity desk, and the head trader wouldn't trade very often, and he would just kind of go upstairs to meetings and come down, and he was kind of an elusive character, and he was a lot of fun. But one time we were sitting on the desk, and he got this call overhead. And what that means is most of our lines would come in, like they would be direct lines to like Ontario Teachers or to various pension funds and big institutional clients in Toronto and throughout the world, and they would have direct lines. But every now and then we'd get a call, what's known as overhead, and that would be like a regular line. And I saw him take this call, and I watched him, and he was like whispering into the line really quiet, like, and I was wondering what the hell was going on. And he has this kind of like 5-minute discussion, and he finishes. And then I hear him whisper over to my boss, who was kind of the younger guy. He's late 20s. I was early 20s. And he starts saying, he says, buy all the Methanex you can. And my boss, like the young guy that's that's his junior, but my senior, says to him, he says, but like how much, with how much of a limit? And he says, I just got an order. And the guy said, I'll tell you when you start getting close. So we started buying Methanex. And I'll tell you, we bought every piece we could on the board. And one of the things is we didn't buy any from clients at that point because we knew we had so much to buy. If we had phoned up and actually tried to get institutional orders on the other side, they would have been mad at us because the order was so big that if they had sold us immediately, they would be mad because later it would be higher. So we just started buying it, and the first day I watched them, and they bought like 3-4 million of Methanex, and they were 80% of the volume. They kept driving it up, and the next day they bought some and kept buying it and buying it. And eventually, people are calling up institutions, or the clients are phoning us up and saying what's going on, and then we start doing some trades, like some block trades. We buying 200 here, 500 there, occasional million print. So for the next month, we trade so much Methanex, and I keep waiting for the order to end. I keep thinking this will be the day. This will be the day we're going to stop buying it because this order is so big. And I just watch this thing go up and up and up. And he keeps buying it and buying it and buying it. And I'm just flabbergasted at the size of this order and the fact that we keep buying it. And so I asked my boss, the late 20s guy, I say to him, who's the buyer? And you got to remember, this is like in the late 90s. So he says, Tiger. Like I'm supposed to know what Tiger is. Like I have no clue. I'm just some young punk on the desk. I kind of look at him and nod my head like I pretend like I know what I'm doing. And I go home, and this is, Patrick, you're going to like this. I couldn't look it up on the internet because there wasn't an internet. I looked up at CompuServe. So I did my dial-in modem, and I figured out the Tiger was Julian Robertson, which is obviously one of the most famous hedge funds around. And they had given us an order to buy Methanex, which is, a Canadian energy stock. And it was so large that it was going to take months to be filled. And I watched this, and I watched us trade this for the next few months. And eventually he slowed it down because he had pushed it up. And he wouldn't. The trader on the other side wouldn't just buy anything that was offered. And they started to, they moved it to a level where they were going to get some volume, and they were going to actually be able to do some trades. But they kept buying it. And I don't know, I can't remember the prices. Let's just say it went from $10, and over the next few months, he took it up to $20. And he seemed to be having no limit to the amount of buying he was going to do. It was just like, it seemed like the blue tickets were endless.
Right.
And I watched the Canadians sell it to him the whole way up, and the Canadians had, thought, oh, this is going to end, and this is a dumb price, and they kept, selling it. The institutional, fundamental clients would say it's overpriced, but, Tiger kept buying it, and it kept going up. Well, then one day, all of a sudden, the head trader, the old guy, gets this call overhead again. And I'm thinking, this is it. This is finally the point where, the order stops and we see that it kind of, that he says he's filled. But it's not. It's not from Tiger at all. And what happens is I see him go into this long discussion. And this one's long. This one takes, like half an hour. And he's whispering into the phone, trying to make sure nobody hears him. And it's going back and forth. And then I see him hang up. And I see him call another guy. And then he goes back and he calls another guy. And there's some calls. And then kind of an hour later, he comes out of it and he says, listen up, everybody. And at this point, I think Methanex, let's say, was trading at $20. Okay. He says, we're going up on a big print of Methanex. And it's going to trade at 18.5 or something like this, which was like down $1.50. Like meaning that the price it had previously been $20, but it was going to trade, our print was going to trade down $1.50. And he said, the buyer is finished and we come out a better seller. So at that point, what had happened was somebody had come and had filled our big buyer and had plugged him with everything he wanted. So like our buyer had I don't know what it was, like another 10 million to buy or something like that. And this big new buyer had come in and said, I see you guys have moved this thing up a long way and it's time, I want to sell this. But the thing was that the buyer knew that the seller wasn't going to go, and to get off that sort of size, it didn't mean that he had to pay up anymore. So he bid lower. So instead of paying $20, he says he bid 18.5. Well, the seller was smart, and he realized that the only reason it was up there was because of the fact that the buyer had been buying it for the last couple of months. Well, guess who the seller was, Patrick?
Soros.
Yep. And that was where I watched Soros plug Robertson on this trade that he had moved up for the last kind of, few months. And he had shorted it because I remember it was a short sale. So he had shorted the entire chunk of Methanex and he had filled them like a butter tart. And I thought to myself, I'm going to watch this because I want to see who's going to win this battle. Well, I watched Methanex go right back down to $15. And it was higher than where it was, Julian had bought it, but it was definitely Soros made some money. And that guy, from then on, just kind of cemented in my mind what a great trader they were. I don't know who it was. I'm not sure if he was doing George or some other trader, because it was obviously my boss. I was just some young puck. Let's try that again. Young pup. And the reality was that I didn't get it. I wasn't privy to the conversations. But I still got to watch what was going on, and I still got to watch how it unfolded from there. And I'll tell you that the smarts and the intelligence and the market savvy to be able to hit a bid $1.50 lower on size because you realize that the only reason it was up there was because of that original buyer was genius. That guy, George Soros and Stanley Druckenmiller, were two of the best traders that will ever live, and I doubt there'll be anyone ever better.
Yeah, you need some capital though for you to go up against Robertson that way, you have to have a bankroll, right? But when you have that and you have the smarts like he has, 100%. What a great story.
Thanks.
What a great story. Well, thanks for sharing that. All right, time to move on though, Kev.
Right. To your favorite part, this week in trading history. What do you got for us this week, Patrick?
All right, well, this week in trading history, I want to take our listeners way back to the 1700s, and we're gonna talk about this trader, this Munihisha. I'm gonna pronounce it properly here after a couple of beers. Munihisha Homa. He's one of the first and one of the most legendary hedge fund managers of his time out in Japan. But
did you just call him a hedge fund manager in the 1700s?
Yes, I'm gonna listen, buddy.
Okay,
I call him this. All right, listen. I'm calling him this. Okay,
so fair enough. I should be quiet.
Let's paint the landscape for this. Okay, so for context, when we go back to the early 1600s, circle back to the Dutch East India Company, right? Which was we had featured on the show before in this segment, which established in the 1600s. I think the Portuguese were there first, but they established a big trading post in Japan, And it became Japan became one of the part of this global network of trade of spices and other goods that were all going around internationally. And so it was influential in making local Japanese merchants incredibly prosperous and laying the foundation from which the Japanese would eventually establish the Dojima Rice Exchange. I mean, the exact date, I think 1697 was, I think, the year that they say was the actual creation of the exchange in the city of Osaka. But the whole exchange was based on rice as the primary currency of trade, as back then in Japan, most labor and soldiers were actually paid in rice. And so it was this exchange where the emergence and the concepts behind trading of futures was actually established, including it was the forerunner of our modern banking system. So a lot of this actually originates back to here, and so we're talking futures and banking all being established back here, and so the rice receipts that these merchants and rice brokers traded were actually used as a medium of exchange and making it one of the first actively traded currencies in the world.
Nice, the rice,
right? The rice, rice-backed currency, right? And so this is where I want to circle back to Morihisa Homa, who was born in 1724. And so he established himself as one of the legendary traders of his time. He had made the equivalent of about $10 billion of today's money.
Come on.
Yeah.
Seriously?
The equivalent of about $10 billion today. So he was like this big, huge trader back then on this exchange. So, but what's amazing is some of the origins of what came from him. So he began recording price movements in the markets on paper made out of rice plants, and he recorded the open, high, low, and close each day. And he started recognizing patterns, so he started giving them names, which led to the development of the candlestick charting we use today. Wow. And that's my preferred way of looking at charts. So whenever we're looking at charts, I'm always using candlesticks. But when we talk about the naming of patterns in candlestick charting, so you hear the names such as the dumpling top or the frying pan bottom or the evening star or the doji candle, all of these things were actually origins to the names that he was giving them back when he was developing these patterns.
I didn't even know. Could you repeat those again? Because I've never even heard of half of them.
Dumpling tops, frying pan bottoms, evening stars. There's morning stars. There's also there's all sorts of these really fun patterns that are in there, and they all have these kind of names because they were all made back in the 1700s.
Yeah.
Right. What's interesting is that he also developed the use of tracking weather patterns, following market volumes to influence his trading. All of this stuff was thing, and he developed an edge in trading against all of these other rice merchants. And that's a great story anyway. But now I want to go back because not only was he one of the forefront fathers of technical analysis in the way that he does this, but it was in 1755 that he wrote a book called The Fountain of Gold, The Three-Monkey Record of Money, which was actually focused on the psychological behavior of market participants and how to make use of it. So he actually is also contributed to behavioral finance and the idea of understanding the psychology behind trading. Wow. And he actually wrote a book on it. And so what's interesting is he described bull and bear markets as yin and yang. And so he describes the rotation of yang, which is a bull market, into the yin, which was a bear market, and claims that within each type of market there is an instance of another. So everything from bull and bear markets to psychology of trading to candlestick and technical analysis was all coming from him.
That's unbelievable. Who would have thought?
Right.
Why
Sorry?
is he a hedge fund manager, though? Why do you consider him a hedge fund manager?
I don't know. I just read something that said that. I don't know.
Oh.
I have no other way of saying that.
Well,
but
you
I mean,
know
look,
what-
it was. I mean, I'm sure he was going long and short the different rice exchange stuff. Like, I mean, but anyway,
He's probably
That's the
doing the
story.
rice arb. The rice arb. You know, when you told me he wrote a book about the 3 monkeys, all I could think about was Brad Pitt in the 12 Monkey movie. Anyways, that's a great story, Patrick. We always
Yeah.
count on you to tell us about, 16th century hedge fund managers. Terrific. Let's move on to the
all right.
WTF
All
clip of the
right.
week.
So, Kev, WTF clip of the week. Why don't you set us up for this? What are we going to
Well,
see?
it's short and sweet this week, and I've had some people say to me that they think that Powell might not raise rates in the coming year, and I kind of say, wow, like
Raise or cut rates?
Sorry, I'm like too many beers. You're absolutely right. They might not cut rates in the coming year, and I think to myself, wow, like he's been signaling everything, but it's one thing for, a jackass like myself to say it. It's another thing for a main kind of strategist to say it. And I was shocked at what I saw on CNBC the other day. So let's play the tape.
So I would argue that what we've got is actually appropriate policy, that you've got the right amount of liquidity in the system given liquidity demand, and that is signalled by stable inflation
rates. What does that mean briefly then for Fed hikes or cuts this year?
So I think the Fed's on hold this year.
I can't see him.
Like the idea, I just kind of laugh because it's something
Hamster
like
on
this.
a wheel.
Yeah,
Hamster on a wheel.
The reality is that there's 100% priced in for a rate cut, and there's a chance of a 50-point rate cut. So for a major bank to be out there saying that the Powell's not going to cut rates is pretty ballsy, and I kind of like the way the guy rolls because you know me, I'm a contrarian. But to think that Powell is not going to follow the market when they've already priced in that certainty of a rate cut is just, it's the wrong bet. It's and if I'm wrong and you're going to play this tape and go, Kev, you were wrong. That guy with his was absolutely correct. I'll be shocked. But a good trader never says never. But otherwise, I still contend it's the wrong bet. When a market is priced that amount of certainty in, Powell is going to go and he's going to follow through. And to be saying that we're not going to have a rate cut is just absolutely hysterical, in my opinion.
All right. Well, you know what? I also think it's look, I think the cuts are coming, but we do need to see. I think we need to see some. Do we? Or actually, do we? What do you think? Do we need to see a downturn in the economic numbers, or do you think they're going to do it anyway?
Oh no, they have to do it now, regardless.
Regardless. So I mean, we could
Yeah.
have an uptick in the GDP next week, and it just won't matter.
Yeah, it won't
They'll-
matter.
they're
He's
still-
gotta-
they're still- they're still
they're
cutting.
going to do this one. I think I'll give you my opinion since we're talking about it. It's a one and done, but that's me. I'm
Yeah,
probably
that is
more
you.
bullish on the economy than the rest of you guys.
Hold on, I'm going to run that hamster scene right now after you just said that. Okay, so let's move on. So the top 5 things to watch next week. But before we do, Kev, let's quickly have a rundown of what happened last week and just kind of see what's going on here. So the European PMIs starting to feel like there's some bottoming going on, no?
Well, there's so much pessimism built into the European economy. Like, tell me anybody that thinks that the Europe's going to do better than expected, and you can count them on one hand. It's even actually it's probably even less than the amount of guys that think there's going to be no cuts this year in the FOMC. So the reality was it was a pretty low bar for the economy to hop over, and it did because why don't you pull up the sheet that you have that shows all the different actual
I'll pull it up
numbers, and
here.
they did it slightly better than expected.
Yeah, they came in, but the question is, okay, look, it's while they did come in better than expected, right? Oh, no, here we go. So while they did come in better than expected, like especially the French flash services and the manufacturing PMIs came in well above 50. I mean, we still have German manufacturing PMI down to 45, still nowhere near being north of 50. I mean, it did tick a point higher.
Right. I'm not going to go and get bullish, but the reality is trading is all about what's priced in. So it doesn't matter. You can't.
It's rate of change as well, and like the second derivative. And so the question is, when is it troughing? And that's a good question. Are we seeing European numbers starting to trough? It's something we're going to be watching in the coming weeks and months, right?
Right.
So let's move on. Lumber and home builders. The lumber doesn't seem to quit.
Yeah,
Look at that chart.
It is running like it stole something. It's one of the best charts. I think what percentage is that? It's basically
over 25%. It went from 300 to over 400. Yeah.
Yeah.
Like, I mean, trough to peak, we're talking 44%.
And that's our good friend Aiden was actually. Remember, our buddy Aiden was always saying that you should buy the tree stocks and buy lumber. I love it.
Yeah, but I mean, but this move is far from over if this is a real breakout, right? Like, I mean, when lumber runs, like, look at that run lumber had back in 2016 and 17, right? Like, when it broke out, it just ran for two years straight, right? And so the question that I'm asking you is, it's been a great 2 weeks, but do you think this is a bigger turnaround?
Yes, is the answer.
Okay.
I think that was the bottom.
But you're bullish on all commodities in general, right?
I'm bullish on all commodities, but if I had to pick one that I like, one of the best, it would be lumber, because I think we're going to have a rip-roaring U.S. housing kind of boom, and I know that's very unconsensus, and like I know.
Surprisingly, though, home builder stocks didn't get too much of a Fed bounce.
No, because I think home builder stocks are actually trading with the bonds, and the bonds had a bad couple of days this last couple. So I think that's right now what's happening there.
All right. Well, let's talk about that small cap divergence continuing, because even though everything got a bit of a pop on the Fed, right? I don't think there's been any real convergence of this divergence. I'm just pulling up
convergence of the divergence.
Yeah, well, I'm going to get all MACD on you here, but no, just but the overall, you can see here, I mean, it did strengthen, but we're nowhere near clearing those February and May highs.
Oh, God.
And we're nowhere near.
All the time. Yeah, but you know what? Let's face it. You came out all bearish on the small caps and talking about how they're so bad, and the reality is they've had a great little run. Like, they're not going to happen. It's not going to happen overnight. It's not going to happen overnight.
Oh my God! You know what? Is there a bet here?
No, I don't. Well, what do you want? I don't know. Sure,
they're dog shit, and they're going to stay dog shit. Is my bet.
Okay, here we go. We got a bet going on. Okay, I think small caps beat. Am I allowed to do NASDAQ, or do I have to do S&P?
No, you could do NASDAQ. So you think small caps outperform NASDAQ? I like that bet.
Okay, here we go. Small caps.
What are we doing, Burger or Duke and Duke?
No, let's do Burger. And let's do it for, till the end of the summer?
Sure. Let's do a third quarter bet at the end of third quarter.
So at the end of third quarter, what is that? I'm not very smart. So is that September 30th?
Yeah.
Okay, there you go.
You're not really. the Q3 that is always Q3. All right.
Okay.
Anyway, so we got a bet going. Small caps continue. Small caps continue.
Yeah. So small caps outperform NASDAQ. September 30th, kind of end from here today. Okay, you're done.
Yeah.
Sold.
All right.
So, oh my God, that burger's gonna taste so good.
All right. So the Aussie dollar. All right. Well, I mean, all these currencies have bounced because that U.S. dollar made that move to the downside. But on a relative basis, this has been an incredibly weak rally from the Aussie.
Yeah.
Like if you compare it to, let's say, the euro making this big punch higher, or the yen, which we'll talk about in a little bit.
Or if you compare it to the Canadian dollar.
The Canadian dollar ripping. Like, look how weak the Aussie dollar's been. I mean, it has bounced, but that's because I think the intermarkets, but it's still the weakest cross currency at this stage.
Yeah, I am
of
so
the developed
bearish on
nations.
Australia. I am Grant Williams bearish. I think we're headed a lot lower.
All right, and finally FOMC statement. I mean, he didn't disappoint on his dovishness, right?
Yeah. Well, to be truthful, Patrick, I, and Tony were drinking a fair amount at the time of the announcement, so we really didn't look at it very closely, did we?
Well, we failed to be paying attention properly.
You know what, though? I actually wasn't that upset about it because I don't know about you, but I never trade FOMC announcements very well. They're hard.
Well, that's why you leave it to John Netto.
That's right. That's right.
No, but John, that he developed a system for doing it. That's where he finds his edge.
Yeah.
You play more of the bigger macro moves, right? And so that initial noise that comes in the first reaction, and rightfully so. Actually, the market almost didn't move at all in the first couple hours. It was really the overnight session where everything happened.
What was interesting was the fact that bonds went bid, and then there was another move higher on bonds after, like, at 6 o'clock when Asia came in.
Yeah.
And that was actually ended up being the high, I believe.
Yeah. Well, we'll talk about the 2-year yield in just a moment when we get
we'll talk about the 10-year yield at 2%. But anyways, have another beer, Patrick. Let's go on.
All right, let's go on. Anyway, that's your review. So let's go on to the top 5 things to watch next week. So, Kev, what's number 5?
Okay, OPEC meetings, Middle East escalation. As I've said numerous times, I think that this is actually something to watch. I'm more worried about Iran than I am about China in terms of wars. I think that it's interesting to see what happened with Trump and the fact that he did not go and retaliate. There's some smart people who are saying, he stood up to the neocons and he didn't respond, and that's actually a positive. Maybe so, but I actually worry that Iran's going to take it as a sign of weakness and that the escalation is going to continue. I'm actually very concerned that this will continue until something bigger is triggered. And I think if you were looking to hedge your portfolio, I still contend I would rather own kind of out-of-the-money crude oil calls than I would rather own S&P puts.
Well, you know what? If I was to offer you my alternative opinion to that, which is I honestly think that Trump has a much bigger plan, and he's going to ensure that the military is completely prepared, and he's going to keep it completely secret. And there's no way that he's going to allow just a little drone drop to provoke him into moving his entire master plan up.
He's like a grand chess master, is he, Patrick?
I know. I honestly think that there's a bigger plan as to what's happening, and they're not going to get provoked by a downing of a drone to accelerate something.
Okay, so Patrick, you know what? I don't like getting into discussions about what's right or whatever, and I think too often, too many people in the markets end up talking about what should be instead of what is. And maybe you're right, I don't know, but I do believe that the market is underappreciating the possibility of the Mideast getting worse from here, not better.
What's the price of oil if there's a war?
Well, I already said it. I think that the chance of $100 is easy.
Really?
Yeah.
100. A doubling of oil.
Yeah. I think
actually we haven't talked about it yet with Tavi. We'll talk about your gold targets in just in a bit. But so you are like uber bullish commodities.
No, well, I am uber
bullish. I mean, you're uber. Oh, come on, you lumber, gold, oil. Like you basically are. I haven't heard you say one bearish thing about which commodity. Nothing. You have so much corn up your wazoo that what are you bearish a single commodity? You're not. You're bullish everything, aren't you?
Well, do you consider bonds a commodity?
No, I'm talking about commodities.
Kidding. Yeah, no, I have a hard time disliking any commodity.
They are cheap. You know, if you're a value guy, you've got one thing going for you is that they're all dirt cheap. Well, listen, I'm long a bunch of commodities, so I'm not going to necessarily try to take the other side of it. But for me, oil's all about 60. If we're clearing 60 on geopolitical news, then I'll totally see your view. But you know
So
what?
if it goes
I'm
higher, you'll buy it. If it goes lower, you'll sell it.
Oh,
We know.
Jesus,
Regular
no.
stuff.
I'm
Number 4.
just not-
Let's go on to number 4.
I'm not just gonna take one. I'm not just gonna take one uptick and suddenly flip from being short to long just because of one day.
Oil's going to
number
go
4.
higher. We're going to be a lot higher.
So
at year-end.
Kev, I want to talk about the Japanese yen, and you on our show back in November, December, January sometime. I don't know what day did that happen. It was like the first week of January, wasn't it?
Yeah.
Anyway,
I'll get it the exact date.
Yeah,
January
no,
4th. January 4th.
Yeah, it was like right the first week of thing, and then we had this monstrous uptick. Let me flip this upside down.
Oh my
otherwise
God!
I'm gonna flip.
Yeah.
Jesus Christ! Hold on a second.
Yeah.
Let me just so that way all the
For everyone
Forex
that's
traders-
listening at home, Patrick insists on putting currencies in the wrong way so that nobody knows what.
Not
they're
the
doing.
wrong way. I always put the base
Anyways,
currency
so
as
yes.
the foreign currency.
So
and I cross it against the U.S. dollar. That way you can look at each currency rather than playing this silly game Forex traders do, flipping their crosses and base currencies back and forth, making it as confusing as fuck.
Yeah.
Right. Like
so listen.
Anyway.
Well, so just go on. So we had this bad
tick,
quote unquote
right?
bad tick, and I think at the time we had our good friend Brent Johnson on our show. Did we not? And both Brent and you laughed at me.
I did laugh at you.
Yeah, you did. And because what did I say? I said there's no such thing as a bad tick. And you said, are you telling me that the yen is going to go back down to 105? And I said, damn right, I'm telling you that. There's no such thing as a bad tick. And sure enough, we're now at 107. We're 2 handles away.
We're not at 105 yet, buddy.
Yeah,
so don't start counting your don't do your victory lap just yet.
I know. I'm waiting for Brent to call me up and say I was right as well, but I don't know how long that'll be. Because not only that, I haven't got a call from Brent about the fact that our basketball team won either. So I'll wait for 105 on the yen, and then I'll hit him up for both.
Yeah, the Raptors did. But you know what? It's amazing to hear all the stories from San Fran, who all the people saying they didn't lose to Toronto, they lost to injuries.
God.
It's...
What bullshit.
Anyway, let's not get getting into
that's worse than talking about Trump. Yeah, for sure.
Yeah. All right. So bottom line, you still think we're going to 105? Yes or no?
There's no such thing as a bad tick. That's all I'll say.
Okay. So now the second question is, when it gets to 105, are you a buyer of the dollar?
I don't know. We'll see when we get there. I'm not as bearish on the yen as the rest of you guys. You guys all think that the yen has to go down and stuff like that.
Yeah,
I love the yen. I actually like the Japanese. Of course, Patrick, we're on the other side of each other's trade, but I don't think the yen is some disaster waiting to happen, and that we're gonna go into a hyperinflation and it's the end of the world. God. You and Kyle Bass can keep shorting the yen, and I'll be on the other side.
All right. Sold to you. All right, so number 3, Kev.
Okay, so listen, I actually went and tweeted out the fact that I succumbed to my bet. Remember our bet?
Yeah.
That we were going to bet whether the 10-year Treasury yield would go to 2%, and I gave in, and I said, it looks like Pat, it hit it, and I was reminded by one of my good friends on Twitter, Carl, that only closing kind of prices count, and that I'm still good. That we haven't closed below 2.
You know what? That's fine. We have this trade isn't over, and I'm perfectly fine with this because I look, we're oversold.
Yeah.
Like
the reason. Okay, well, one second before
there's gonna be.
I want to interrupt here because the reason you're perfectly fine with it is because Patrick thought for the longest time, he kept telling me it was a stake bet. Sure enough, this was kind of like a couple of months after yields were going lower. All of a sudden, it's a stake bet. And then we had
I was going to go wagyu on your candy ass. and
it turns out it's only a Duke and Duke, which is just $1, and which is really funny. So now all of a sudden he's like,
it's not even a burger. It's not even a burger. It's $1.
Yeah. You know what? Personally, I'm actually more like Duke and Dukes mean a lot to me. So I have I don't want to lose a Duke and Duke either. The question is, is it a closing level or not? Am I still good, or am I like, you tell me? Did you win the bet? I'm willing to concede it if you want to concede it, and I'm willing to let it run.
No, I'm gonna win this fair and square because I don't think we're stopping at 2%. I think we're going below. It's just a matter of time. We're gonna, you know what? I wouldn't be surprised if we saw 2.25 in the next month. There's gonna be a retrace. There's gonna be a bounce on this, but I'm gonna win this bet clean. I don't need to win by a hair. I'm gonna win this bet very clean. So I'm going to give this to you. I'm telling you right now, I honestly think we're going to 2.25 very shortly, but it's only going to be an oversold condition that is just offering a bounce or overbought on bonds. But I'm going to be buying the dip. I'm going to buy the dip on the bond market. It's this simple. You're going to lose.
This is awesome. Thank you very much. That's very kind of you. Your confidence is actually very heartening to me.
All right, financials number 2.
Okay.
All right.
So
I want to talk. No, I want to talk about this.
Oh,
right?
I'm sorry. I'm supposed to shut up.
No.
Okay,
Yeah. You're supposed to shut up now.
Okay.
So the financials are just. It's almost as bad as the Russell. They have just not begun, and I'm talking the large caps here because the small caps, the KRE, the regional, have been even worse.
Yeah, they are ugly. I'm not going to defend the regionals. They look like shit. But you do what you want to do here on the XLF, and then I'm going to get a shot at it.
No, but listen, I'm actually not making a market call here. I am just asking the question is, can you have your little kumbaya melt-up session that you think that is super bullish on this whole stock market without the financials participating? I mean, they are, in my mind, one of those kind of beta 1 core parts of the financial system that need to be participating for us to have a big rally. I mean, do you really think that, like, A, are you still super bullish? And 2, do you think the financials run with it?
Okay, first of all, it's not going to be kumbaya. It's going to be like twist and shout kind of crazy.
No, it's going to be twist and shout crazy.
I don't know. I'm trying to think of a crazy thing. I couldn't think of anything. little pathetic, I know. Well, it's just, I don't know. Helter Skelter, I'm picking Beatles songs over and over again. I'm giving.
All right.
Anyways, so listen, XLF, let's pull this up because I'm shocked that you as a technician are telling me that this is so ugly looking. To me, and I am no master of the dark arts. Like, I do not know this. I do not know this stuff. But it looks to me like we cleared the previous, like, overhead resistance at 26 and a half. 26 and a half. Draw this line here, the previous highs from February and March.
This one here?
No. What over here in February and March, buddy? That's like May.
Okay. Yeah. These highs.
There you go. Yeah. So it looks to me like we cleared that. We're trading above it. We've come back down. We tested it. And then we had a big up day. Off to the races, baby. I don't know. I don't have a clue. I don't know. You guys with your dark arts. I don't know. I think we're headed higher, man. Like, that's it. I don't care what you're saying.
You heard it right here. Buy financials because Kevin said so. All right. So
Okay.
number 1.
G20 meetings.
G20. Yeah. So, I mean, there was a lot of people that are saying there's 2 things. The Fed, whether the Fed was going to be dovish, and 2, whether or not there was going to be progress in trade deal talks at the G20. And, I don't think anything gets done.
Really? You think
I don't
nothing?
think so.
No?
Nothing. I'll tell you why. This is just my humble opinion. But
It's not so
Xi
humble usually, buddy.
Yeah, absolutely. Xi has no incentive to help Trump out unless Trump is willing to cave. Like, what? Why the hell would at this stage? It's Trump that needs a deal more than Xi.
Oh my God! You know how many people are gonna email you and like Patrick Ceresna, Big Picture Trading or whatever it is, your email. I don't want to hear it. Like, you're gonna get a lot of hate mail for that, buddy.
You think so?
Yeah.
You think so?
Yeah. Everyone's telling.
But am
me.
I wrong? Am I wrong?
I actually don't think it matters to the market as much as everyone else thinks it does. And I don't know.
By the way, I appreciate you giving my email out to everyone.
I think I got it wrong
for
anyways.
the hate mail.
I think I got it wrong anyways. No, I don't know, man. Like I'm kind of torn. A little part of me says that as much as you're arguing that Trump needs a deal more than Xi Jinping or whatever. Xi Jinping. Xi Jinping.
Oh my God!
So you think he needs a deal more, and so you think Trump's going to roll over?
No, I don't think. I don't think that anything gets done.
Oh, you're the opposite. You think that Xi Jinping is going to say, "Screw you guys"?
Coming out of the G20.
Yeah, I think. Okay, this is what I think. I think they're going to somehow come up with a very watered down deal that somehow doesn't really accomplish much, but gets them to both able to say that they did something. That's my call.
Well, if that's the case, S&P's north of 3,000.
Well,
if you're right.
That's consistent with my views.
Okay. Well, I'm not so optimistic, so I'll take the other side of your deal. Okay. All right. So anyway, that is the top 5 things. We'll see. That's we're obviously positioning slightly different on this, but we'll see how it plays out. So anyway, parting words of wisdom. So I wanted to circle back to this great little saying. And it says, take every gain without showing remorse about missed profits. Because an eel may escape sooner than you think. It is wise to enjoy that which is possible without hoping for the continuance of favorable conjuncture and the persistence of good luck.
It's very wise, Patrick, but you realize this is 2 eels in a row now. And you chose this one. Yeah. So this is a second eel.
I do not know why eels and profits go so well together.
They just do.
It's a perfectly good statement without having to add the eel into it, right?
Yeah, that's true, actually.
Profits could escape sooner than you think. It's like, it's not, you didn't have to add the part that it's an eel in there. But anyway, it's still wisdom with eel or without eel. But what I do take away from it, though, is that one of the hardest parts of taking profits is dealing with the regret of watching the stock continue after you sold it, right? And what happens is because so many people can't deal with that emotion, they would rather hold and then get out way too late, if not get out at all, and just hold all the way down the other side because they just can't deal with the idea that they sold too soon.
Right. I'm still obsessed with the eel. You know that the British eat the eels? They love them. And they make things that the Queen has to eat them, and it's just nasty. And I think that we as Canadians send
honey badger nasty.
It's just nasty. Exactly. And jellied eels. And I think they make some sort of stew or maybe a pie out of them. And I think that we as Canadians help them out with it because they've eaten all the eels out of their streams. So they come to Canada. They're like, oh, we need some eels because we've eaten all ours. And well, you guys don't seem to be eating all your eels out of your streams. And they just love them.
What? I know Lena's trying to get in on this at some point because she's probably sitting on here why don't you guys let me in on this? Anyway,
okay. We'll call it a night. We'll call it a night. Let's. You know what? How about we do this? Let's say goodbye, and then we'll get Lena's opinion about eels.
All right. So let's start. Well, listen. Thanks everyone for joining us.
Yeah,
stay for the after hours show because we have more of Tavi coming up, and it was a great conversation. You're gonna love the rest of it. It actually gets really fun.
Yeah.
And if you want, make sure you register at the Market Huddle website because if you do, you get an email every week notifying you of not only of the release of the show but also the slide deck, so you can check out all the charts and all.
That's
the
right,
because
cool Tavi's got a great pack that we didn't get to all of the slides and stuff. So it's always important to get the emails because it helps out in terms of seeing the guests' full package that we often don't get to because we're too busy giving them our time.
Absolutely. So you could also follow the Market Huddle's Twitter at the Market Huddle. You can follow my Twitter at Patrick Ceresna. You can follow Kevin. Go ahead and make your own plug.
At Kevin Muir. Thank you very much for everyone. And thank you for Tavi for putting up with us. Thanks for Lena for listening to us and drinking beer with us. Thank you for listening. We really appreciate it, and we'll see you next week. Okay, joining us now is Crescat Capital's Tavi Costa, where we do a little after hours. Tavi, we were talking earlier and we found out that you're a little bit of a tennis star. Why don't you tell us about that?
I don't know if a tennis star, but appreciate that. Well, it's actually an interesting story. I started playing tennis when I was kind of late, actually. 14 years old is kind of late for tennis, but
for sure, that is really late to learn to pick up tennis. Most of those people that end up being kind of superstars like you, they started at like 8 and 5, right?
That's that most of the guys I used to play with or started very young, but yeah, it was an interesting time for me because it was a kind of a hobby at the beginning, but obviously it got really serious, and it got to a point that I didn't know exactly. You're kind of young, you don't know if you're going to go to if you go to college or try to play professional or whatever, and obviously. I actually never thought that well, later on speaking, it's a lot easier to say that, but I never thought that I really had a shot to be a real professional. And one day I was playing a tournament, and I had a person recruiting me to play at Liberty University in Virginia. It was for being a Brazilian, it's very expensive to come to America. I didn't come from a wealthy family, financially speaking, and so that was really great. I came here pretty much on a full ride, and moved to Virginia and started playing tennis for Liberty University, which was quite the challenge, given that I didn't speak a word of English. And
wow,
you
came to university without speaking a word of English.
Oh gosh, I mean, I have so many great stories of how of things that I've said or things that I've tried to do, or it's been a mess.
English is 1 second. I just have to say something. English is Patrick and our first language, and yet we still have those same stories.
Oh, I don't know if you do.
We struggle.
Let me ask you a question. Have you tried to buy a soap for just a body soap, or and instead of that you bought a dishwash soap, and those are the kind of things I've done in the past, and or there was a story that I said to a cop once. I parked my car. This is a funny story. I'm not sure if I was parking my car.
You gotta tell it now. You gotta tell it now. Yep.
Yeah, it's a funny story. I was parking my car on campus one time back in the days, and somebody I just got somebody else's cars, and then after I parked, I went to my apartment, and then I just hear somebody knocking on the door. It was a cop, and I was like, oh my gosh, what do I do? I don't know what I did. And the cop was, I could kind of understand him at the time. It was like my second week in the U.S., and he was telling me that I couldn't park where I parked, and that I was supposed to get a ticket. And if you're learning English, you know that the difference between saying a sheet of paper and shit. So he told me that I had to sign this sheet, and then I came back to him and I said, I have to sign this shit. And then he looked at me. He was like, what? And I almost got arrested for that one. It was very close. And until my roommate came up and started talking to the cop and started saying that it wasn't necessarily what I said, what I meant, and it was really bad. And I mean, I've had many stories like this.
That's really brave. Actually, I'll tell one quick story. I have a friend that moved to China in the 90s. And, China or Mandarin is a guttural language in terms of like the way you pronounce things matters in terms of how, it'll change the meaning of the word. And I remember him telling me one time he thought he was ordering like this buffet full of like fried chicken or something. And it ended up being that he got a huge buffet of fried scorpion. And I said, scorpion? And I'm like, holy shit, what did you do? And he says, well, first of all, you have to eat it because it's like saving face is really important. And then he said, it's further proof that you can deep fry almost anything and it tastes good.
Yeah.
Okay, so let's talk a little markets here, Tavi, because I know you guys are big Canadian real estate bears. I don't disagree with you that we're long due and overdue for a correction. What is your thinking here? Why don't you talk us through your strategy, your thoughts, and tell us how bad you think it's going to be?
Well, everything started with once we kind of had a strong view on China, then we started looking at, accumulating the numbers of China's current account throughout history, and realizing there was kind of a distortion of way too much money that they had in dollars that they had accumulated, but that wasn't really translated on the foreign reserves, and there was kind of a gap there. And that was what they used to call the twin surplus of the capital and current account being positive at the time. And for us, that kind of meant to be more of a we thought that's kind of it's really impossible. If you think about the balance of payments, they should balance and not have those two. And there was some illicit capital outflows happening, and that's when we really start looking at Australian and housing and Australian and Canadian housing markets, because we thought that the capital outflows are kind of exacerbating those the prices of real estate in those places. And that was really the start. And then we began to look at the more in depth of especially Canada of the household situation and how much leverage they have, and looking back versus comparing that with 2008 and 2007, right before the housing bubble here in the U.S., and just the price to rent. There's one way anybody can do this, is just take all the numbers provided by I think it's the IMF or the BIS, I don't remember right now, that provided what they call the Housing Watch, I believe it's called, and they provide lots of indicators like price to rent, price to income ratio, and some other things like credit that is related to like mortgage outstanding and so forth. And you can kind of see that if you create a model just kind of ranking all those things, you can see that Canada is by far it is by far the worst, and unfortunately it doesn't have Hong Kong and China there. Otherwise, it would be somewhere at the top as well, if not at the top. But that was kind of the beginning. The second part of it too was looking at the labor markets in Canada, look kind of similar to the U.S. being at all-time lows, and or in the U.S. not at the case all-time lows, but in Canada is definitely one part of it. And when you look at that and you see what the corporations, we put out this research looking at the free cash flow of non-financial companies in Canada, realized that for the last 12 months, Canadian non-financial public companies in Canada have actually about 82% of those companies have lost money on free cash flow basis. So when you put that together, how do you sustain low unemployment rate and the consumer being highly leveraged as well? So and then who's holding the bag? And then we start looking at Canadian banks, obviously, because that's usually where it starts to see the problem. And Canadian banks' valuations, at least when they were at the top until 2018, some of them are after their highs already, or all of them are, but some of them peaked in the beginning, others in the middle, others in the end of 2018. And when you start looking at those, valuations actually look a lot very similar to the U.S. banks in 2007, 6, and even right at the peak of the bubble. So it made a lot of sense to us to be short Canadian banks, even though they pay a lot of dividends, and it's a little bit expensive to be short them. But we're looking at a big move. We're looking at a 30-40% move down on Canadian banks, and if you're looking at moves like that, then it makes sense to be short, even though they're kind of have a cost of carry here. But so that's kind of the I would say one way to tell the story in Canada. But Australia is very similar story too.
Yeah.
All right.
So Patrick, I'm going to interrupt here just because I love this part of Tavi's position. The one thing I will say that I'm doing this trade, and I'm doing it with I'm short the Canadian banks and I'm long the U.S. banks. If you go look, I think a lot of people don't realize it, but if I said to you, what do you think that the average tax rate would be on a U.S. bank for the past couple of decades?
Oh gosh, I have no idea.
Yeah, and most people think, oh, well, you know what, it must be fairly low because it's the U.S., it's a low tax state and stuff. But, the reality is that it's actually significantly higher than what Canadian banks have been. So let me get you the numbers. Because I think you might find this interesting. So I did a study and I looked at the banks. I used the KBW U.S. Bank Index, and I looked at it from 2000 to 2017, and I saw that the median observation, too many beers, that's what's happening there, was 31.3%. That was what was the average tax rate or the median tax rate of those U.S. banks. Then in Canada, I looked at it and I said the same period, it was 22%. And this has been flipped on its head with Trump's tax cuts. So now all of a sudden, the U.S. is on equal footing. The Canada has got an overextended consumer. It's got an overextended banks. And I'm just like, to me, it's a theme that I love in terms of you should be buying American banks and selling Canadian banks. Canadians, for some reason, even though we're an oligopoly and we get overcharged by banks, every single Canadian loves their bank stocks. It's crazy.
Yeah. It's so Kev, when you're doing this trade, are you able to more or less create an offset on the dividends? Are you getting something similar on the banks you're choosing in the U.S.?
Well, let's go have a look here. I unfortunately, like a fool, chose KRE to be long because I thought that the
poor thing.
Yeah, I know. So I was kind of an idiot. But let's just look XLF, right? Like that's a cleaner one. So XLF has got a dividend yield of, let's just look here, of 2%. And let's look at the Canadians and just take an equal weight Canadian one. And that is trading at 3.5. So there's no doubt about it. The Canadian, there's still negative carry. But I still look at those, and the other thing about it is, although we're talking about the tax rates, it's not like you're paying more for the U.S. banks. On a price-to-book basis, it's actually much cheaper. And it has to do with the fact that Canadian banks have done so much better for the last, couple of decades, and they've just printed money. But even if you're just half right, Tavi, then I got to think that these two spreads they'll converge much more so.
Yeah, no, absolutely. There's another part too. It's the credit markets in Canada look even worse. You think the U.S. looks bad at being close to 55 to 60%. It varies on a daily basis on the amount of inversions in the credit markets in the U.S. But Canada actually takes another 10 percentage points higher than that. It looks extremely bearish right now in the credit markets in Canada. So I think that obviously financials being in the cyclical bucket here, if there is a downturn economically in Canada, I think that obviously the Canadian banks will be in a very tough position. So will Australian banks too. But for me, I don't disagree with you. It's just for me, the only problem is if I do believe that how does that? Let me ask you a question, I guess. So how does that play out if you're a bear? If you have a negative outlook for U.S. stocks, how does that play out being long banks in general here in the U.S.?
So, I guess that's where we're differ because you're obviously much more bearish on U.S. stocks than I am.
I was gonna make that comment, right? Because Tavi, me and you are quite bearish in terms of where we are in the position in the market. Kev's far more bullish. He thinks that the market's about to melt up in his little narrative. But and so the idea of being long U.S. banks is a little bit trickier. When you start building a narrative where you think U.S. equities are going to correct lower in that. But what I wanted to do is just change the topic a little bit, if you don't mind me going off topic from this thing. But I want to go back to interest rates because, you did show the inversion of the curves and you talked about real yields and so on. But I don't know whether I got a sense of where you're positioned on interest rate trends and bonds in general, because me and Kev have this big debate. Obviously, I'm still a bit of a bond bull, and he's quite the bond bear, and so we're completely on opposite spectrums of this. But I agree with almost everything that you've said. I'm bearish to equity markets, long precious metals. I'm bearish on China, bearish Canadian housing. So far, you've impressed me. So you're right in line with everything that I think. But where are you on this bond picture?
Yeah, so that's a tricky question. So we we think that the 2-year yields are likely to drop much further, but there's a difference between, in my view, of that's more of a move that I'm expecting to see. However, it's hard to implement that trade, in my view, in a big way, especially, like you have so much capital you can invest. And I don't see a big trade here that I can, make a lot of money by shorting 2-year yields. And so what we do here, we're actually kind of agnostic in terms of that. I mean, in terms of, not agnostic, but I guess we're not taking a position in that way. What we're doing is actually we're being long treasuries in the 10-year yield, but being short the German bonds. So if you looked at the spread between those two yields, they tend to converge as you get late in the business cycle, and it's obviously caused by the divergence of monetary policies between the two countries, or the two, the ECB and the Fed, and you can see that relationship as well. I put out a chart a while ago of looking at the Euribor versus LIBOR as well. And, if you look at those spreads, you can see, I mean, they reached a very extreme level, and it's been kind of breaking down recently. And one way you can see that, you said you like the 5-year real yields, you can see this relationship on the 5-year yields and is spread between German bonds and treasuries. It's pretty interesting that, the 5-year yields is already kind of, the spread and 5-year yields is already kind of leading the way. And the 10-year yield spreads is actually forming this kind of head and shoulders pattern. It's breaking down from a head and shoulders pattern. And it looks really bearish for us that rate, the spread is likely to converge as we see the economic conditions deteriorating here. But
So
one second, Patrick.
Kev,
I got to jump in 1 second. Tavi, you realize that you guys are advocating the trade that knocked out the original bond king.
Thank you. I was about to say that. That's the Bill Gross. That's the Bill Gross
trade. Yeah, no, absolutely right. But Tavi is right that in this latest move, this latest reach for duration, U.S. bonds have outperformed basically the rest of the world. And so even though the boons have been continuing to go even more negative, the reality is that the U.S. 10-year has done even better. So that spread trade has actually worked, and Bill Gross might have top-ticked that spread. So. When he wasn't busy filling his house with fart spray.
Well, we kind of joke at that as well here at the office that that was kind of a I said, I think in one of the tweets I did, I said the Bill Gross trade is back or whatever. But and the other way you can see that is when you look at that divergence of 30-year yields across the globe versus either the Fed funds rate or LIBOR rates, and you see the spreads kind of turning negative in a big way. In other words, inverting versus 30-year yields across the globe. It's what that tells you as well is maybe U.S. rates are a little bit too high relative to the rest of the world, and that's just one way to do it, and that's kind of how we find a easier to play this. But it's the part of for me that is hard to take a long position on treasuries is I kind of believe on the bear theory too of treasuries of what's happening with the U.S., of the amount of leverage in the government and households and corporates and so forth. And I think that eventually we're going to see higher interest rates. I don't know when that's going to play out, but I believe in that story too. It's just when you have that relative to other things like German bonds, then I think the U.S. rates are a little bit too high, and maybe there's some juice there that you can kind of squeeze it out from that trade.
I was hoping to hear him go 4 for 4 in terms of agreeing with me on everything, or 5 for 5.
Yeah, you know what, Patrick? The only guy that'll do that is our buddy Alex Gurovich. That's the only guy that'll be good enough for you, buddy. Because if anyone,
I would love to hear the other part of it. What's your view? What's
God, you don't want to hear the other part of it.
Yeah,
it's just a load of shit.
Tavi.
It's just drivel. That's all it is, Tavi.
Well, listen, Tavi, we're going to Chicago. Both Kevin and I. We're going to be at the Chicago Trader Expo there, and we have John Netto who's going to moderate this bull bear debate. And we're going to be on there on stage doing this very debate. So I'm not going to waste all of my good ammunition.
You're not going to waste your ammo. Patrick, if you're going to give the plug, you might as well give the full plug.
What's the remainder?
July,
and then, of
July
course,
21st. Make sure you sign up.
July 21st, and more importantly, what's more important than the actual
that's right.
event?
Don't worry about the
is gonna
expo. Don't worry about the Trado Expo. But there is a Market Huddle event after.
Yeah,
that.
where all of our listeners are invited to meet us. We haven't announced the bar yet, have we?
No, we haven't.
We haven't.
But I have
we
a
saw-
couple of kind of suggestions, but we're going to figure it out. You know what? And I think we're going to make sure that they force feed you to drink some sours.
Oh yeah, that's gonna be
one
force
second.
fed. No,
Tavi's a young guy. Tavi, are you? May I ask? This might be too personal. Are you a millennial? Because you're a younger guy.
Yeah, I am a millennial. No, I'm 29 years old. So
you're a millennial. Great, awesome, great. Okay, so listen, Tavi.
Yeah.
Do you like sour beers?
I do. I enjoy
Yes,
it.
yeah, I love it.
I don't drink beer though much. I prefer whiskey, but I drink beer
there's nothing
too.
wrong
But
with
Something about these millennials and their sours. Like, you know what? I was just talking about how much I like the millennials. I think they're a great generation. But the one thing that I just cannot kind of wrap my arms around is their love of sours, because it's just a god awful beer, and yet we've yet to find one that is like that we've managed to have two of.
I actually have found sours that I drink now.
Seriously?
Yeah, you know what? Our sponsors have converted me.
Yes.
I have.
No. 1 second. Let's be honest here. Patrick just runs out of beer in the fridge, and he's like, "There's sours there. I better drink them." That's all that happened.
I mean that contributes to that, but I'm not opposed to sours anymore, Kev. I'm not.
God. Well,
I won't go and buy a 2-4 of sours and sit down and make it a sessionable day. But it's I do enjoy the sour every once in a while. Now.
But I didn't catch this. Is the sour beer kind of a new trend? I didn't know that.
Yes, for sure. And it's something the millennials love drinking. It is a new trend, and the millennials love it. And it's
the Gen Xers like us, we're just used to like lagers and pilsners by the 2-4, and you just
But we get all these sponsors, and they send us sours trying to convert us, and they sound like it's finally worked on Patrick, but it's going to be a long time for me before I like the sours. Like, you know what? It'll be a long time before the sours. Like I'm actually choosing one of those.
So sour beer and some avocado toast, I guess. That's a very millennial thing.
I like the avocado toast, and I like the millennials.
I'm out on that. It's way too expensive. I just look at that and I'm like, this is crazy. I mean, it's I don't know.
They're not growing a lot of avocados in Denver for sure, where you're located. But I like the avocado toast, and I like a lot of the things the millennials do. But that is the one thing that I will have trouble doing. So, anyways, make sure everyone joins us. Market Huddle event after our great bull bear debate on July 21st. So that's it for the shameless plug. Let's talk some markets. How far do you think the gold's going to go, Tavi?
If you ask me, I think it's going to go at least 20 to 30% higher here. But especially I think a good way to look at that actually, that it's kind of my target here is looking at that long gold in CNY terms versus the global stocks ratio. And right now that ratio is at 4.3 or so. I think it's fair to say that this ratio could rise as much as, go all the way to 9 or 8 once it gets all the way top to that part of it. I think that's when I'm going to be happy to unwind completely from that. But right now, I think gold has it's at the very early stages. Obviously, had a big move in the short term, and it's, it could certainly see a pullback. For the last few years or so, we've had so many of those. Large sell-offs of whatever, if it's a conspiracy thing of whoever is selling $2 billion of contract of gold of. All of a sudden it's we're likely to see stuff like that again. Yeah, maybe, but I think gold is poised to go much higher here. I'm here on the long term. I'm here for 1 year or 2 year kind of trade of being long gold. And I think on the Real Vision I did a presentation of, and I put out a target for GLD because it's just kind of easier to. For retail investors to position that way. I think I said at 140. Right now it's at 130. So, but I think it's going to go at least, 30% higher from where it is today. But
okay, so Tavi, I'm going to shock you because I've said for a long time And this is Kevin speaking, not Patrick.
Yeah.
So everyone, just so they know, because you know what, Tavi, they say we sound the same with our Canadian accents and the slurry words from too many beers. But I think that we're going to have a period where I'm not saying we're for sure going to have this, but the possibility exists for us to have $1,000 in a week. And I know that seems crazy. That is how, I honestly think that if the central banks, if China comes for the gold, it is such a small market. I think people underestimate how much it could go if the central banks decide that is something they need to own. And I think people underestimate the possibility of that kind of outsized crazy move.
No, Kev, you've had too many beers.
No, I've said this for a long time, though, Patrick. It's not like this is a new thing for me to say. And I'm not saying it's for sure going to happen. I'm not saying it's going to happen today. But I do believe that if you look at how, Grant Williams has a great piece where he says it's called What If or something like that, where he talks about how small the gold market is compared to all the other asset classes and what would happen if everybody, if every portfolio manager just decided he was going to have 50 beeps of his portfolio in gold, his or her portfolio in gold.
I think the stat was, if correct me if I'm wrong, but something like the market capitalization of all gold miners is the same market cap as Cisco Systems.
Yeah, it's so small. It is such a small market, and I'm not trying to say that it's worth that and it's for sure going to go to that. I'm not like Eric Sprott or those guys who think there's no gold in Fort Knox and all that. I just believe that if they come for it, if we get a real rip-roaring bull market, that the possibility for this thing to go is way, way higher. You look at palladium, and palladium got squeezed this last year, and it had some trouble, and it got the curve inverted, and it got the supplies got tight, and that thing doubled. Palladium doubled in a year. And this could happen in gold. And I think one of the things you should watch for is you should watch for the futures for the curve to start doing some funky things. And when that starts to happen and we start to see, the spreads between the months doing weird things and showing that the supply is tight, do not fade that. Do not say, it's going to get fixed. At that point, it's when you want to double up and get even more bullish. Anyways, that's my 2 cents.
Well,
no, I'm
bullish, but not that bullish. But anyway, go on.
Yeah, no, I don't disagree necessarily with. I think gold could go parabolic. It's not. I don't think it's necessarily a wrong thesis, but the whole what is it called, the gold bug mentality is I subscribe to that mentality. I agree with it. I just for me is just that's kind of too much of a long term kind of play, and obviously hasn't worked for years, and everyone thinks that those people are crazy. But I agree with that. It's just I'm actually seeing a lot of signs on the short term here of why gold looks attractive, from the implied volatility, all these ratios versus U.S. stocks and so forth, and how even. This is even putting inflation on the side. I mean, that's kind of I guess a question for you. How does that? Do you think gold could go that high without inflation at all? I mean, is that something?
Well, I think gold is more important is real rates, and when you look at the move that we had in, let's just look here. We had very little inflation from 2003 to 2011. Yet gold went from $280 to $1,800, and the reason that occurred was because real rates were low and to even negative. So
and the U.S. dollar lost half of its value, right? Like the dollar index during the 2000 to 2007-8 period. Here, let me pull it up, just because it was an influence.
You're right.
It was an influence, right? This was the dollar trend, right? But rates were a big factor too. There's no doubt.
So I just think that the gold is more sensitive to real rates than it is to inflation. And everyone looks at 1970, the late 70s, early 80s bull market, and says gold is correlated to inflation. Well, no, because the reality is we had rip-roaring inflation, but the real influence was the fact that rates were lower than inflation. So real rates were negative. And I think that real rates, and that's why I loved your TIPS 5-year yield chart. because I think that is one of the biggest drivers. So I look at it and say, do I see governments that are interested in having real rates high anytime soon? And I say no. And I think that we saw Powell trying his first of his, I legitimately think he wanted real rates high and he wanted to snuff the bubble. And the reality is that he got punished for it. So I just don't see governments anywhere having the stomach to sustain real rates being high, and therefore gold is going to go higher. And I think that if they get stupid with real rates, and if we do get a situation where inflation does take off and the Fed and other central banks don't chase up rates with them, then that will be what kind of institutes this kind of mad scramble for gold. And I think Grant Williams will be bang on in that. When all these guys and girls, portfolio managers realize that they don't have nearly enough exposure to this, they could go parabolic. Anyways, I sound like I should get my tin hat
out. You should.
Yeah.
Yeah. I mean, if you look even this month, I mean, this is a research I was working on right before this podcast. I don't even know if I want to be able to share it correctly here, but let's see if I can share correctly. But anyways, it's if you look at gold move this month, which moved in a big positive way, I believe it's up 5 to 6% or so, maybe a little bit more than that. And for the whole month, right? So month to date performance. And then if you looked at equity markets, it's still up 6 to 7%, I believe, month to date as well. And I'm looking at Dow Jones here just because it goes back further in history, and you can go back to the 1900s or so. And if you looked at, even though gold was pegged at some periods of those, and if you look back in history, how many times you had months, a month like that both of them rally at the same time. It only happened 4 times in history. So it's really rare actually to see both of them moving as much as they did this month. It's what we're seeing today is it's a real outlier. Which, I think I always thought kind of that the biggest, people would say, well, what if the Fed starts easing? How does that play out with your short equity play? And I always thought that, precious metals would be the best hedge here. And it's kind of playing out that way. I'm not saying I didn't get things wrong either, but that was one part of it that I got it right, which is it's been playing out perfectly as a good hedge of the equity market moving up. It's been precious metals that are definitely, kind of unleashing something that hasn't really done anything for years. So anyways, I think that what's happening this month especially is quite an outlier type of move, and I think we're likely to see gold moving a lot higher.
Well, there you go. So Patrick and I are both long gold, just so you know, Tavi. So I think you should maybe be thinking about selling, because when the two of us agree on stuff, it never works.
What do you guys think about miners?
Well, we're Canadian, so we always love them. Like, the reality is that Canadians are always like, oh, you know what? I got this little development play in, up in the Yukon, and I'm gonna do it. So we're always bullish, don't you think, Patrick?
Yeah, it's
kind of in our blood. When you're born in Canada, they when you turn 16, they give you, instead of getting a car, you get some Vancouver stock certificates of the local miner.
Well, some of those guys are trading so you can find some gold miners trading at 5 times their reserves of gold reserves. Yeah. And if you think that it's gold's going to be trading much higher like you do, those guys are trading in really cheap levels here. So I don't know. Yeah. I think there's a lot of room for consolidation. I forgot the name of the guy. There's a really good presentation that I think not a lot of people watched, unfortunately, on Real Vision of this guy. I forgot his name now. I guess I'll send it over to you guys later. But of him talking about how the gold and silver mining stocks are, you're likely to see a lot of consolidation, and talked about a little bit of some of the stocks that he thinks are cheap as well in the whole industry. And it's a really good case. It's not a macro case at all. It's more of a micro and kind of an industry led kind of thought. But it's really interesting how, I agree 100%. I think those guys are in the real bear market for a long time and overdue for a move on the upside.
So, Mark Twain said it best. He says, a mine is a hole in the ground with a liar standing next to it.
Oh
And
gosh,
it's-
I'm
and
sure there's a
often,
lot
too
of
often
those.
too often that's a Canadian.
Oh,
And
God.
we have one of our favorite guests is Cuppy, and it's Harris Kupperman, and he's gotten burned so often by Vancouver stock promoters that are like doing some things. He's like, I am never buying another Canadian venture stock exchange like stock again in my life. And so, anyways, Canadians have a long history of mines, and we seem to love it. And it's been a long time since there's been some excitement in the mining square. So it'd be nice to see it happen. I hope you're right. Tavi.
Oh,
I hope that those get going again.
The sketchy ones are the ones that have mines in Brazil.
That's right. That's even worse. Speaking of Brazil, I have long thought that they are the most lovely people. They're often so kind and stuff. I had a woman that worked with me, and she was Brazilian, and I thought that they were just the nicest, kindest people. And you've done nothing but kind of confirm that belief I have, in terms of my, belief of what the Brazilians are like. I remember one time that I think that Dennis Gartman said something about the fact that the two nicest people on the earth are Brazilians and Irish people.
Oh, that's a very nice compliment. I really appreciate that. I'm honored to hear that. That's really great. I hope we all keep doing that.
So Tavi, since we're on Brazil, here's the index. What's your call here? Is this a new bull breakout?
This is Ibovespa, right? I think that the Ibo, I don't buy Brazil.
There we go. No one ever trusts their own.
That's right.
It's just like us shitting on Canadians.
That's right. It's like home country bias in reverse. Like the professionals all think that it's the end of the world.
I think it looked like a total bear here, and I just want to make sure this is a tactical kind of play. I'm not a perma bear by any means, but I just think that there's it's been kind of a delusional trade here in Brazil of people really thinking Brazil is it really shifted after the elections and so forth. And I don't think that I still think Brazil is, you can, one chart that is very interesting, you can look at industrial, just the industrial commodities index. I think Bloomberg has an index on that. And if you look at that versus the Ibovespa on a year-over-year basis, you can see that actually follows each other very closely. If you think that copper and so forth will be moving a lot lower, iron ore, and because of a slowdown globally, I think that Brazil is going to get caught up on that too. But Brazil and dollar, those are very different charts. If you look at EWZ and obviously Brazil, Ibovespa in local currency terms, they look very different. I like the Brazilian. We have a small short position on EWZ, but I wish there was an easier way to short. There is a way, but I think that the shorting Brazilian stocks in local currency terms seems a little bit more attractive to me than in real in dollar terms like EWZ.
So what's your call on real?
On the real, I mean, I think the real has been Brazil has done a lot of easing policy. If you can look at the divergence between the interest rates in Brazil versus the Fed policy, interest rate policy, and you can see that Brazil has been easing significantly relative to that, and that kind of at one cost, right? So obviously equity markets has been on fire. Things have been great there, but at one cost, the currency actually just got completely demolished by that type of economic policy. Yeah. But I think that the real here is, I'm not bullish on the real, but I think it definitely had a big move on the downside. But it tends to, as if you're a big believer that the Chinese currency is going to devalue, you would probably think that the real would follow the same pattern. But I think that the Chinese currency, the Hong Kong dollar, look a lot more attractive to short than the Brazilian real, given the move that he had. It's like shorting the Aussie dollar. I mean, just chart the Aussie dollar versus the interest rate differential of U.S. and Australia and then 10-year yields, and for like 5 years or plus, and actually all the way back to like 2000s or so. And you can see that, given the interest rate differential, you would expect the Australian dollar to be trading even lower, break down from that base right now and go down even lower. But it's just we're not doing that either. It's just kind of watching. I think there are better plays out there. They're still on the top, and one of them being obviously the Chinese currency and so forth. But
okay. Well, Tavi, we're going to wrap it up here. It's been a pleasure having you. For those who want to learn more about your place, let's do it again. So tell them where your website and then your Twitter handle.
Thanks, guys. It was fun. So my Twitter account is at Tavi Costa, and the website of the firm is crescat.net.
Well, thanks again.
Perfect.
It was a blast getting to know you.
Yeah.
and
Did you have a
learning
good
about
time,
yours.
Tavi? Did you have a good time?
Oh my gosh, I had a great time. This was
that's
incredible. I loved it. Just really laid back. It was great. I loved it. Very cool.
All right.
Okay.
Oh, well, listen, Tavi, thanks for being on the show, and we'll have to have you back sometime for an update.
For sure. Thanks again, Tavi.
Absolutely. I'll be happy to be back. Thank you, guys.
Take care.
All right, cheers.
Are you there?
Yeah? No. Are you still there? No, I did not hang up.
Okay. Let's just go in there. Lena, leave that in as well.
How bad was this, Lena? Was this a bad episode?
No, I mean
it was awesome episode. What are you talking about? Now, Lena, what were you thinking about eels? Do you have something to say?
You said it's gross. It's delicious.
Yes,
Have you
yeah,
ever
I knew
even
that.
tried it?
No. So you know what?
You can't
Lisa-
say something is gross until you
So
try
you're
it.
absolutely
right?
correct. I 100% agree with you that it's bullshit for me to proclaim judgment on eels before trying it.
It's like a delicacy in many
Yeah.
countries.
So I completely agree with you. My wife has a friend that is Filipino. She's a very nice, lovely lady, and she eats all sorts of nasty shit.
Oh, I bet
And,
I eat a lot of nasty shit. that
Yeah,
you don't
and you know what? Did you ever have? This is the one that disgusts us, and I realize that it's just, you know what? I'm sure to some people like burgers are gross or whatever, but for
like to vegans.
yeah, exactly. You know what? We do a lot of disgusting stuff, but this one I have trouble with, and if she's listening, which I doubt she is, she's the first one to admit that it's kind of hard to get around, but it's the fertilized egg. Have you had that one?
Oh, the 1,000-year-old egg or whatever they talk about. It's like
I don't know if it's 1,000-year-old.
No,
That'd be pretty
well,
nasty.
I think
but
that's what they call it. But,
oh, okay. But
no,
Patrick,
I've never had it.
it's an egg that is being fertilized. So there's like, but you get it before the thing forms. So there's like a beak and stuff, and you have to like chew through that part.
Yeah, I've never had it. But
So Patrick, are you a buyer?
I'm just not going to say anything else. I'm going to stay out of this conversation.
You don't want to offend everyone like I have.
Oh, I've already offended enough people for the day.
yeah, there's a lot of slaughtering of Asian names, I think, in this episode.
There wasn't slaughtering. You know what?
I did not nail them at all.
I thought you did pretty well, but then again, I probably have no judgment. But so tell me about eels. What did they taste like, Lena?
What do they taste like?
Yeah.
It's hard to describe. It's hard to compare it to.
I've had the barbecue.
Yeah,
I've had
like
the barbecue
barbecued eel is basic. Like if you go to a sushi restaurant and you get barbecue.
That's a pretty
eel
standard
sushi,
one.
That's pretty standard. I would
And there's
say.
no funky taste to that. That tastes pretty good.
And they're usually marinated in something or covered in some sort of sauce.
Yeah, but isn't that just the clue right there? The fact that you got to cover in some sort of sauce shit to make it taste good.
Oh my God.
That's bad news.
Thing, no? It's like don't put anything on your burger. It's like don't put salt on your burger, right?
Well, no, but salt is different than like marinating and leaving it in a whole bunch of stuff. Anyways, listen, the British
Look, if
love
you
it.
have like beef if you have like beef tartare or something like that, it's got shitloads of stuff in it to make the raw beef taste good.
Yeah.
Like you don't just eat the beef. Like it's got all sorts of other seasonings and other things to mask the fact that you're eating raw meat. Right? Like I mean, anyway.
You're right. So listen, I'll tell you, I'll admit to something. I do believe that when you go somewhere, you should try something. So I should go, next time I'm in Britain, I should have eel with the Queen. But until then, I wanted to let you know that when I was in Iceland with my old high school best friend, we were there and we went out to a restaurant and we were looking through the menu and we realized that one of the things they eat in Iceland is puffin.
Really?
Yeah, do you know what puffin is?
It's that bird, isn't it?
Yeah, it's that cute Disney bird. So I had one.
And did they have Bambi right beside it?
Yeah. I was like, I gotta eat one. I'm in Iceland. Like, how many times are you in Iceland? And
does it taste like quail or something?
so it's like a bad duck. So you know what? I had my first and last puffin, but I remember my wife. We sent her pictures, and she's like, "Oh my God, you ate a Disney character or whatever." And I was like, "Yeah, but we kind of had to." And then I thought about it. Why is this puffin's life any better than a chicken? Like, really, how much smarter is a puffin than a chicken?
It's all about cuteness, dude. You don't eat cute animals.
Yeah, so I disagree with that. To me, it's about intelligence. Like, if cows got smarter, I'd feel bad about eating them.
Pigs are pretty smart.
I know. You know what? But if pigs were really smart, why are they so goddamn tasty?
That's true. I agree on that. Why are these so tasty?
I'm done. Forget it. You guys. I'm done.
Let's call it a night. Okay, let's call it a night, everyone. That's a good one to leave it on.
All right. Cheers.
Okay. Have a great night, everyone.
Have a good night, guys.
You too.